Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from my diversified portfolio of high-yield funds. And I did make a video on EQCL, also HEQL, a couple of weeks ago or 8 days ago. I don't know when this video is going to come out, but this is the thumbnail right here where I really go into detail on HEQL and EQCL. In today's video, I'm going to focus more on EQCL because I gave you kind of a cliffhanger at the end of that video, at the end of this video here. Will I be investing in EQCL? Right, so EQCL I feel is really like HEQL, is a game changer for us income investors because it's really a first of its kind where not only do you have diversification sector wise, but it's really diversification region wise as well. So think of this one as an HEQT, XEQT, VEQT, but for income investors, an income version. So it combines index ETFs, mostly covered call ones, right? If we look at the holdings, you're going to have USCC, CNCC, QQCC. These are Horizons covered call, which I'm a very big fan of, covered call ETFs. And by the way, EQCL, this ETF here, which another thing I really love, it uses 25% leverage. Now they do have another ETF called GRCC, which is kind of the unleveraged version, but I'm really going to focus on EQCL here. I think it's a game changer. It has about 11% yield. It's brand new. It's 4 million in net assets. It's growing very quickly, and that's a pretty high net assets for a very, very, very new ETF. So I think it's only going to get bigger and bigger. But it's very interesting because it's kind of like a VEQT and XEQT for income investors. You have your typical exposures of the biggest chunk in US. So those ETFs typically have an S&P 500 and NASDAQ, which you have. Then you have a Canadian exposure. Then you have international developed exposure outside of North America. So things like Japan, Australia, Europe. And you also have a little bit of emerging markets. So these ones, they're not covered call ETFs. These ones are. So the $1 million question, will I be investing in EQCL? It's kind of like a new one-stop shop for us income investors, right? Because it has pretty much the whole world. The answer is no, and I will explain to you why. So the main reason why is, number one, these are not all covered call ETFs. You have the emerging market one and this one here, HXDM, these are all obviously Horizons ETFs. They're not covered call. They're actually growth ETFs. So you have 30, 40 to about 42% out of 125% that's not covered call. That's not really income oriented. And hey, for some of you that works out. That's fine. You would like a little bit of growth in there. So, but for me, I'm a pure 100% income investor. I'd rather have everything covered call. I don't mind that. I'm comfortable with that. So that's reason number one. Reason number two, so basically what I'm trying to say is, let's say this was a covered call ETF or this was a covered call ETF, maybe I would consider it because I'm pretty sure that maybe the yield will go probably from 11 to 13%, right? So it would be much more attractive and I would definitely consider it much more. But I would say the main reason is that these ETFs here, so the HXDM and the HXEM, emerging markets and developed outside of North America, I don't really care that much to have that exposure. So you might be asking yourself, but why? It's good diversification. You have Japan, Australia, and Germany, and UK, and a little bit of emerging markets. There's potential for growth. Listen, guys, I think I'm at a point now in my investing, not career, but investing journey where I'm going to feel comfortable, or I feel most comfortable, and I am okay with getting mostly North American and more specifically US exposure. I think that the US market is king and always will be king long term just because they have the best environment for businesses. They're the most capitalist. I'm not really a fan of a lot of these the economy in France and UK. It's a lot more socialist, I would say. I'm not saying they're bad economies, But emerging markets, China, I don't really want to invest money in China. I don't like what's going on there. I don't really care for that. I don't want to put my capital there, something I don't support. But more than that, the numbers speak for themselves. These economies or these style of ETFs, they always underperform the US anyway. That is the biggest reason. So this one here and this one here from Horizons, they haven't been around too long. You have the emerging markets one, 2020, and you have this one here a little bit longer, 2017. But what I did is I took some Vanguard and iShare kind of equivalent ETFs so we could look at the performance, and they've been around for a lot longer. And what you will notice, let's start with the developed outside North America, right? So guys, this is gonna be Japan, United Kingdom, France. Right here you have the big four economies in Europe, right? UK, France, Switzerland, Germany, but you also have a lot in Japan, typically a lot in Australia, Hong Kong, a couple of other European countries. It's mostly very, very similar, if not the same, for all these style of passive index ETFs to get exposure to developed economies outside of North America. If we look at the exposure breakdown, you look at the geography, it's a very similar, right? You'll see the very similar exposures. Of course, it's going to be diversified as well. So this is the iShares 1 XEF, which is very similar to HXDM. I'm making the comparison here, but let's also look at the Vanguard one. VIU would be the Vanguard one in Canada, right? Developed all cap X North America. When you see X North America, it means excluding North America. And if you look at the portfolio, and do you have the geographic here? I don't know if you do. Yeah, here's the countries. It's going to be very similar. Okay, I just want to make sure you understand that we're looking at very similar stuff here, because I want to try to figure out how HXDM performs. Let's look at the performance. You see, since inception, 4.83, but like I said, hasn't been around for that long. This one's been around for longer, so the performance is going to be a little bit more accurate. 10 years, 6.44, inception, 7.65. Not terrible. Let's look at the performance of the Vanguard one. Pretty similar, right? Inception, 5.24. It's even lower. 5 years, 5.91. What's the 5 years? 6. So this one's a little bit higher. So what I'm trying to tell you is that for this one, for these exposures here developed outside North America, guys, they underperform the US, and I believe they will continue to underperform the US, right? If you just look the performance of an S&P 500 or something like that, it's just gonna blow these performances out of the water. 10 years, 5 years, even inception, pretty sure. Now, same argument I have with emerging markets, right? If you look at the emerging markets performance, and this ETF has been around for quite a while. I tried to choose the ones that have been around for at least 10 years. So I didn't show you here, but this one here, 2013. Okay, they're both over 10 years, which is great. So the emerging markets one, 10 years of data. It's a lot of data. Look at the last 10 years. The average total return per year, 4.38 since inception, 4.56. So it's even lower. Emerging markets is even lower than the developed outside North America. Same type of thing for this one here, the Vanguard one, which is VEE, right? You see the performance here, 10 years, 4.50. So I feel like I don't really, number one, I don't really care for these economies and those corrupt governments. I'm not saying the US is amazing, there's no corruption there, but the biggest reason is I don't want to put my money there, but the even bigger reason, they underperform anyway, and I think they will continue to underperform. So I don't understand what this whole emerging markets craze is. I don't care for it. I think it's just going to continue to underperform the US. So that is really the reason why I won't be investing. Personally, EQCL doesn't mean it's a bad idea. I think it's a great game-changing fund. Especially if you want a little bit of growth mixed in there, these ETFs are growth. I wish they would be all covered call, but I guess they don't have a covered call emerging market index ETF or developed outside North America yet. So that is the reasoning why I won't be investing in this one. Doesn't mean that you shouldn't, but I'm just giving you my my thought process on how I think of these things, because I've been getting a lot of questions. Are you going to be adding EQCL? I rather hold the USCL. I don't have QQCL yet. Maybe I'll get it, but I rather have the US stuff. And I do have a little bit of Canada as well. I don't have CNCC or CNCL, but I got BKCL and ENCL, which is kind of gives you most of Canada anyway in my portfolio, right? Like you saw in the recent unveil. So that's my thoughts on EQCL. Yes, I think it's a game-changing fund, very convenient, all-in-one, one-stop shop, but it's not 100% income. It's not 100% covered call, and that's what I want, because I am a 100% pure covered call income investor. But hey, if you like having a little bit of growth, unfortunately, I wish, it would be better, in my opinion, if you take these out and actually put an S&P 500 and a NASDAQ 100 instead. But that's just how they formulated this ETF. They're really going for the all equity worldwide. So that's completely fine. I think it's a game changer, but I wanted to give you my thoughts on it. So let me know what you think. Let me know, do you agree with my reasoning? Or maybe you disagree with it. Are you getting EQCL? If not, why not? Let me know in the comment section below, and see you next time.